You've got three pools that you can essentially put your investments into, and each one of these pools is going to get taxed differently. So you've got the tax-free pool, the taxable, tax-deferred. Tax-free, that's going to be your Roth IRA or Roth 401k. Taxable, that's any account held outside of a retirement plan, any kind of a capital asset outside of retirement. Then tax deferred, this is going to be your 401k, your IRA, TSP, kind of your traditional retirement plans. Now, when money goes into a Roth account, it's going in after tax. Once it's in the account, it's going to grow tax-free, and when you withdraw from the account, it comes out tax-free. So no better rate than tax-free. Over here in the taxable account, this is when you put your after-tax dollars in. That starts your basis. And let's assume, maybe a $50,000 investment. And then as it appreciates in value to $100,000 and you sell it, coming out of this taxable account, you get preferential tax treatment, capital gains rates. So that's going to be at, depending on your income, can be as low as 0, 15%, 20% for high income earners. And then out of this account, this is where in your 401k, your IRAs, TSP, money has gone in on a pre-tax basis. So when it comes out of here, you're going to be paying the highest tax rates. So this is going to be taxed as ordinary income when the money comes out. So the reason you want to have tax diversification is so that you can create a tax-efficient retirement income. You want to have the ability to pull from all three pools to create your retirement income. So like Joe said earlier in the show, if you have pension, Social Security, you'll want to pull from this account only what you have to get up to the top of the tax bracket, and then maybe pull from tax-free and taxable so that your standard of living might be up in the 24 or 32% tax bracket, but the most you've paid in tax is 22.
Yeah, so Pete, I think when we talk to people, they have most of their savings in tax deferred, which of course is the highest tax rate. So how do they get more money in the tax free?
Great question. So in building up your various accounts, you've got a couple of options with getting money into the tax-free, because this is really the golden goose that's going to allow you to control your taxation on your retirement income. And so you've got a couple of options. First, if your 401k plan allows Roth contributions in it, you can make direct deposits through your 401k plan. Outside of that, you've got two other ways. One is you can do Roth contributions, where you're taking after-tax dollars and you're making a contribution to the Roth, and you have to have earned income for that. So that's $6,000 plus another $1,000 if you're over 50 that you could put into the tax-free account, and you can do that as a spouse as long as there's enough earned income. The second method would be to take dollars out of the tax-deferred and convert those dollars into the Roth account. Now, when you do the conversion, that's going to be taxed as ordinary income, so you want to be mindful of where you're at within your tax brackets.
Yeah, so if people can have money in each of those pools, if they will, then they can control their taxes in retirement a little bit better.